Welcome to the Invested Dads Podcast, simplifying financial topics so that you can take action and make your financial situation better. Helping you to understand the current world of financial planning and investments, here are your hosts, Josh Robb and Austin Wilson.
All right. Hey. Welcome back to the Invested Dads Podcast, a podcast where we take you on a journey to better your financial future. I am Austin Wilson, research analyst at Hicks & Zerker Capital Management.
And I'm Josh Robb, director of wealth management at Hicks & Zerker Capital Management. Austin, today we have a lot of fun stuff, but first, how can people help us grow our podcast?
Yes, absolutely. We would love it if you would subscribe. If you're not subscribed already, so go ahead and hit that subscribe, follow, whatever that button is, hit it. That way you get new episodes when they drop every single Thursday, and we would love it if you would leave us a review. That is how you can help us. But today, we are excited because we have a special guest, friend of mine, who is going to be asking the questions that everyone else is thinking but hasn't really asked. Right. So I introduce to you Mr. Shaun Meloy. Shaun, welcome to the show.
Hello. Thanks for having me today.
Of course.
It's exciting to be on somebody else's podcast. It's weird to hear somebody else do the open and the close later on, and then to be able to walk out of here
and be done.
And not have
you
to
don't have to edit.
I know.
I don't have to do anything to it. I just get to sit here and just dump all of my questions.
Brain dump.
That's right.
It'll be wonderful.
And
so, yeah.
I brought a question for Shaun.
Oh, right now?
First question. Very easy.
You did not tell me there would be questions.
There is.
This is a two-way conversation.
How frustrated do you get? Because your name is one of those names that can be spelled many different ways.
Yeah, like 3-4 ways.
Yes. I think one of the most differently spelled names that I can think of.
Mm-hmm.
Does it frustrate you when someone takes a shot at it and misses? Or
no, not anymore. I mean, you grow up a lifetime of looking at the souvenir rack with all the like little license plates with everybody's name on it, and yours is never there. And if it is there, it's spelled completely wrong.
Oh, of course.
Yeah. So you grow up with that sort of that level of disappointment over and over and over and over again, that when you get to my age, you're just like, whatever. And so when people say, can I get your name? And I'm like, Shaun, at least some people, a good majority of people will do you the courtesy of saying,
can you spell that?
Or they'll
take a guess.
More often than not, though, it's A-W-N. I'm like, it doesn't matter. Just spell it however you want to.
As long as you say it the right way.
Yeah. I'm like, I don't care how you spell it. Like, it is what it is. Just go with it.
Okay.
So just as long as you call Shaun, then I'll know. Except when we went out to lunch the other day.
Main Street Deli.
Like, yes, a place downtown. There's like 3-4 people in there that all were Shaun.
Well, they all stood up to
funny.
go.
We were sitting there having lunch it was an hour of lunch. And while we're eating, we already had our food after a while.
Yes.
And while we're eating, I bet Shaun came up 5 times. And I don't know what it was. Other people's orders named Shaun, desserts, drinks, who knows what they were ordering. But I was about to go line up again.
I thought about just going up.
Like,
I was keeping an eye on the counter. Like, what are they getting?
If it looks good.
I know.
I know.
I could diversify to something else for
but
round
see, that's
two.
the risk, though. I don't like onions, and they put a lot of onions on stuff. So.
Yeah.
Life's too short not to eat onions.
Yeah, but I'm glad to be here today. Thanks for having me.
Yeah, so Shaun, I guess introduce yourself a little bit. Talk about what you do. Talk about your family and your interest in the world of finance.
Well, as you said, my name is Shaun. I've been married to my wife for about 15 years now. We have 2 little kiddos, one 11, one 8. That's Cohen and Laurel. And I actually work at a church here in town. I do mostly communications stuff, a lot of graphic design, audio production, because we have a podcast, and I produce and edit all of that.
Which we'll plug in the show notes and link that in the show notes as well. So check out the Gateway podcast.
It's fine, whatever. People don't need to listen to me. But I do that and do music too. I play
a little bit,
yeah. So
that's actually how Shaun and I met.
Yes.
So back in the day, this little college kid walked into Shaun's office and said, I want to play guitar.
With a buzz cut.
Oh, yeah.
With a buzz cut.
I want to play guitar. And Shaun's like, oh, you know a bar chord? Sure, you're in.
But he was a pretty solid guitar player, and he had good choice of footwear. So I said,
matters.
Yeah, let's take a risk.
And it worked out.
Listen, I analyzed the fundamentals.
That's right.
And I
made a recommendation.
I made
did a cost analysis, and for free we can bring him on.
But yeah, that's Shaun.
Yes, that's me.
So finance wise, so you're obviously you've been around a couple market cycles. You know what's going on.
Did he just call you old? Is that what he just did? Being around a couple market cycles?
I am 40. We're at the older end of the millennial spectrum.
Yes.
So we're the elder statesmen.
Mm-hmm.
Elder millennials.
We've been through all the things.
Yeah.
We've been through all of them at this point. I went to school for business, so I had finance classes. So that's kind of where like my interest like a cursory interest.
Oh, yeah.
A hobbyist's interest in finance comes from. So when things are going wonky with the stock market,
Yeah.
that's probably the worst time to be texting an analyst.
Yeah.
But I'm like,
happens.
Austin, check this out. Like
Yeah.
all these things
Yeah.
that I catch on the news or whatever or whatever I'm
Twitter.
listening to. Yeah, Twitter. I follow a couple economists and whatnot on Twitter. That's a weird thing to do, but it's fine
It is.
when
It's
you're not
good.
in finance.
Yeah.
But just kind of trying to understand the world.
Mhm.
I think most Americans probably, when we talk about, the economy, they think the Dow Jones Industrial.
Yep.
And I'm like, well, that's a piece
Right.
of it,
Yep.
but that's not the economy.
Yeah.
And so I always have just by nature of what I went to school for and by my own general curiosity about the world, that's where my interest in
There you
finance
go.
comes from.
Absolutely. And you came prepared with some great questions
Yeah.
today. So, Shaun,
You don't have any questions that you guys have to hash out so I can see
I mean, we're on the same
You
page
want to
all
get an
the time.
argument? Yeah. There's a couple we could start. The one question that keeps popping up, and this is something that I get asked all the time by clients, is, are we in a recession? And that's one that we could get into debate. And we actually have done some podcasts talking through that. But the idea of a recession, like you talked about, the economy and the market are two different things, and for the economy to be in a recession, it's got to be officially
Announced
announced
by the NBER.
Yep. But historically, in your classes, they probably told you 2 negative quarters.
2 negative
of
quarters.
Gross domestic product, GDP, is the way to determine it. And I think this is the first time that has happened without it actually being called a recession yet.
Let me ask you this. So everything that's going on in the economy right now, there's some confounding factors there.
Yeah.
True.
That are leaving people,
Yes.
I'm assuming like Austin going,
Yeah. What's
scratch
happening?
my head.
Yep.
This doesn't make sense in light of this thing over here.
Yeah.
Yep.
So do you feel like them saying, no, we're not ready to call the game on a recession yet? Is it just like a little bit of denialism or like, let's just be safe? I mean, because when somebody announces it's a recession, I mean, the market typically just has a full-on freak out.
It's not a great
right?
thing. Yeah, I mean, so the thing is that when you look at the economy of the United States, 70% of it is consumer driven, right? When you look at the fact that we have 3.5% unemployment and we have...
Which is historically low,
Which
right?
it is.
Very good.
Yeah,
That's a good
we have,
thing.
We have 3.5% unemployment. We have 10 million job openings right now. And we have consumer spending that's holding up really well.
In spite of inflated prices.
In spite of
like
8% inflation.
Yeah.
That's when the NBER says, wow, we have all of these good things going for the consumer side of things that represents 70% of our economy. How could we be in a recession, even if technically because of things like inventory building or trade balance, we got flipped slightly negative for 2 quarters in a row? The consumer parts of both of those quarters were very favorable.
Mm-hmm.
I think that's what's giving the NBER a pause to say, whoa, I don't know if that technical definition really hangs right now, where as an analyst guy, I want the yes or no. I want the answer.
Yep.
I want to know, are we in a recession based on numbers and facts alone? They're not willing to make that call yet.
Yeah. So I think it's part of it is saying that word changes people's mindset.
Yeah.
So they want to be careful about that. And then the second part is broad economic downturn. And their argument is it's really not broad yet because labor and unemployment and sales are still looking pretty strong. So it's not broad yet. We're feeling it because inflation impacts everybody. No matter what your income level is, you feel the cost of goods adjusting. The lowest income earners feel it the most, but everybody feels it. And so I think it feels worse now. And I agree that they're saying, it's not broad yet. It hasn't affected the whole piece of our economy. But it's just one of those weird things that, you add in politics and an election year and all that. It can get dicey on, what they're trying to do. And it comes down to, though, is whether or not we're in a recession, are people making the right decisions they need to? And that's where it comes back to is, even when go back historically, look at years where we technically weren't in a recession, but things were slowing down, you need to be making those changes anyway. So just waiting for someone to officially say recession shouldn't be the trigger point for you making adjustments.
Yeah, and I asked that question about denialism because, the economy's cyclical.
Yep.
And generally isn't sort of the prevailing wisdom that you have a recession about every 7-8 years.
Yes.
It's been 13 since the last one.
Mm-hmm.
So
Excluding COVID.
and that was so weird because that was kind of like a hard reset.
Yeah.
you know, because a free market, it can only get manipulated so far before that free market's going to say, nope, the rubber band is snapped. You've stretched it too far. I have to rebalance myself.
Exactly.
But I'm like, was COVID though like a market correction, or was it just like extenuating circumstances due to a century event that nobody foresaw?
Well, the interesting thing is we've talked many times, and you've probably heard about yield curve inversions, right? So that would mean when you're looking at bond prices, obviously you can have bonds across different maturities, and generally speaking, a shorter term bond is going to have a lower yield than a longer term bond.
Yes. They reward you for hanging out.
Yes,
longer.
exactly.
Okay.
So in times leading into economic downturns, you often have what's called a yield curve inversion, where you have higher yields on the front end of the curve and lower yields on the long end of the curve. And we actually, ironically, had a 2 and 10, which is the yield curve everyone looks at, 2-year bonds versus 10-year bonds, yield curve inversion in 2019 before COVID, even though there was no sign of a global pandemic or a global recession coming. That would confirm that theory going, like, you're going to backtest this for 100 years and it worked every time. We had no idea there was a pandemic coming, yet we had that sign coming. So very, very, very interesting sign there.
Yeah, and it's just been so interesting to hear just general people talking like, oh, I think we're headed for a recession. And early on, I would have been like, yeah, totally. Like,
Right.
I don't know what I'm talking about, but sure.
Right.
But now you've got some economists saying, no. You've got Jamie Dimon saying, oh, yeah, we're like 6-9 months out.
Yep.
You've got the president, which, I mean, this could just be all election season politics, saying, no, I don't think we're going to. And if we do,
It's
going to
slight.
be slight, shallow, quick. We're in and out.
Yep.
Like it or not, the government has some pretty savvy economists working for them.
Yeah.
And I take his opinion the least. It would be any president, because their words are the most powerful.
Yes.
If they say we're heading to a recession, everybody listens to what the president just said, and they almost made that a foregone conclusion.
Yeah.
Right? So I think they always have to be more optimistic and less doom and gloom just because of the weight that their voice carries. So I think they're not going to admit we're in a recession until we're like right in the middle of a recession.
I know the president. I don't know who Justin Wolfers is.
Right.
Exactly.
Yeah. That's what I mean.
That guy?
They got to be very careful what they say. So I think historically, presidents are always going to say, yeah, if we do, it's going to be light. It shouldn't be a problem, because, I mean, that's part of their job, is to help encourage and kind of keep things rolling as long as they can.
So I'm listening to these two guys.
But yeah, they're on the other end.
Why should I listen to Jamie Dimon about it, though? Like,
Yeah.
he's the president of a bank.
Yeah.
And like, what, the United States' largest bank?
It
Like, why
is.
should I, like, he's going to understand how to navigate a recession. And in a lot of ways, banks look to capitalize off of recession. So why should I listen to that guy?
Yeah.
Well, he's been through it a lot, and I could say one reason that Jamie Dimon has kind of earned the status of pretty smart guy when it comes to what's going on.
He's out there, yeah.
A lot of the market looks at Jamie Dimon and what he has to say. And I've over the last few years, I've really noticed, like, well, Jamie Dimon. And I'm like, why?
Well, it was the global financial crisis that really put him on the map as like a guy who kind of knows what's going on. So
The one in 08 or
one
just,
in 08.
Okay.
Yeah. So the one in 08 really made a lot of decisions during 08 that made JP Morgan the behemoth that it is today. And actually before that, he was part of mergers and acquisitions that got it to have all of the different arms that it has right now. So his navigation of 08 was really what everyone said, oh, wow, that guy actually knows what's going on from a financial institution perspective. Now, again, that is disconnected from politics. That's disconnected from other areas of the market. But from a financial institution's perspective, they're the largest, and they're running, I think I heard the other day, they've got $1.7 trillion of cash. Now that's consumer cash as well as their own cash on the balance sheet. But they know what to do with their money when things are looking a certain way. So I think people are looking to him because he's been through some sketchy stuff before. And the banking system, one thing people don't understand is that our financial system today, in 2022 in the United States specifically, around the world is a little bit different, but the United States specifically is so much more stable, so much more capitalized in terms of having assets to back up liabilities than it was in 08, in 09.
Yeah. We're a lot more stable now than we ever have been. So, I don't think he's probably as stressed about going into recession as 08 or 09 when banks were really worried about their balance sheets. Yeah. But he's probably looking around at what he sees. And that's the other thing about JP Morgan and a lot of these banks is they can look at what their consumers are doing trend-wise, because they actually see checking accounts and savings accounts, and they can see who's holding cash, who's not, how much cushion do they have, how much do they have in, kind of, day-to-day, week-to-week cash flow, and know, hey, if things do get rough, there's going to be a lot of people hurting, and as a result, they know how that'll impact the economy. So they can kind of see some of that stuff.
So maybe should I listen to Jamie Dimon a little bit more, like as a consumer, as, you know, an everyday person? Should I listen to him a little bit more? Because he's, in a way, he's probably going to have my interest at heart a little bit more than these other two guys are.
He's boots on the ground for the consumer, right? He's living in the consumer world. He's lending to consumers. He's got consumers' cash on hand.
If I'm making money, he's making money.
That's
the only other incentive he has is he likes higher interest rates because they increase his borrowing.
Yeah.
You know, and so for him, when the Fed is raising interest rates, banks have just seen this increase in what they can then lend out, which from a spread standpoint, they're making more money. And they're not obligated or forced to raise savings rates at any equivalent rate. So as that spread widens, they're making more profits. And so the only thing that kind of puts him in a different corner than you is that he loves higher interest rates, whereas the average consumer, we're not a fan of higher interest rates. I don't want to borrow a higher interest rate.
There is a conflict of interest, obviously. Yeah. And I know just JP Morgan just had earnings like this week. And JP Morgan had record quarterly net interest income. So the interest that they're earning on what's on their balance sheet, they just had record ever. And the Fed has only started raising rates in March. And we're already at record levels of interest. So if they continue to go as they're planning on doing, which is a whole other topic I'm sure we're going to get to, if they're going to continue to increase interest rates for the next couple quarters, whatever that looks like, that spread is only going to get wider. So there is a notable conflict of interest when you're talking.
He wouldn't mind maybe a slow recovery out of here where the Fed has to keep rates higher for a while because they're just going to bank all
Print
that
money. They're going to bank.
Let me ask you this. So there's been that figure that's come out over the last couple of weeks with the interest rate rising because it was like 25 basis points and 75 basis points. And how much because now this time a year ago you were getting mortgages locked in at like 3%. Now it's like 7-8%.
Yes.
And before, if your budget was like $3,000 a month on a home, you could afford to take out a $800,000 loan. Now it's more like $3.
Yep.
So is for like a Jamie Dimon, a JP Morgan, their balance sheet, is it better that they have high interest but a lower mortgage? Because then if they default on that's less money that's being taken out of their pot or they're having to worry about versus a higher amount. So less buying power. Is that better for them that we can afford less?
It is in that it spreads their risk out. So if let's say they were going to loan $700,000 a year ago, they'd get one mortgage out of that. But this year they'd get two mortgages out of the $700,000. So they just diversified the risk.
Gotcha.
So if one defaults, they still have half of that income still coming in. So their default risk is mitigated. So to answer your question, yeah, they do like that. If all else things equal, they're getting the same income between the two, higher interest rate, lower price. They're going to take spreading that risk out instead of one large one.
That increases their customer base.
Absolutely.
Okay.
Yep. And the interest spread is huge on a 7% mortgage rather than what it would be on a 3% mortgage. So they're earning more interest on a 7% mortgage as a percentage, obviously. Factor in home price appreciation year over year, which a couple months ago was at like the highest we've seen in a long time, 20% per year, or increase year over year in home prices, average home prices in the U.S. Factor in that and a 7% mortgage versus a 3.5% or whatever that would be. So doubling your mortgage rate and a 20% increase in your house. The average mortgage went up 100% for the same house.
It doubled, like you said.
Same house.
Insane.
Yeah, purchased last year versus purchased this year. The same house was twice as much on a monthly payment basis.
And I've heard that there's a lot of some of the more recent data has indicated that a lot of people that sold their house and then bought a house during the period of whatever that real estate are regretting it.
Yeah.
Because there was so much selling yourself out just to get into another home because I'm going to skip inspections, this, that, and the other thing. And now people are like, my house is all these problems with them. I lost all the equity I had in my old house. Normally you would hope that you would sell for more than you bought in for. And you'd be able to contribute that to a down payment, or you'd be able to just have, you have all that equity built in. But then when you have to pay more for the next house, a lot of that goes down.
Right.
So you're in a worse position now, it seems like.
Well, and your home value is going down slowly right now as well. So things peaked out a month or so ago. And when you think about what a 7% 30-year mortgage does for home prices, it puts downward pressure on them because the home affordability is less, So if mortgage rates are going to stay as high as they are or go up, that's going to continue to cool off housing price increases. And so these people could end up theoretically then being underwater.
So that was going to be my next question then. Are we looking at a picture where there's a bunch of people that overpaid for houses And now if things continue like they are for 6, 7, 8, 9 months, there's a real danger of people being underwater.
Yeah, there is, but the difference between 2008, 2009, where we had the housing crisis, and now is fewer people are using adjustable rate mortgages.
Yes.
That was a huge problem in 08, 09. Now you have a fixed rate. The difference between then and now is even if your home price goes down and you're technically underwater, as long as you can make that fixed payment, and we just talked about unemployment being historically low, people's income is not in jeopardy at this point.
Right.
And even if my home price went down, it means I probably can't or don't want to sell, but I'm not in danger of foreclosing or losing, because the banks, even though you're underwater, they're not going to come back to you and say, hey, we got to readjust this. You have a 30-year mortgage. As long as you're making the payments, it's indifferent to everybody that the housing price is adjusted. So there's less danger of the homeowner needing to foreclose or walk away or any of the things we saw in 08, 09, because they've locked in a low interest rate. And as long as their income stays the same, because that's the other thing, is banking got a little bit more strict on who they're lending to.
Well, that's
so
what I was
we
gonna
should
bring
see
up, is
fewer foreclosures
quality.
from that. Yeah.
Credit quality from a loan origination standpoint is head and shoulders above where it was standards-wise in 2006, 7, 8, where subprime mortgages were norm. You didn't have to have any credit. You could buy a house as a working fast food or whatever. It didn't matter. You can have a $400,000 house for nothing, but now you have to have a pretty good credit score to get a decent rate on a mortgage.
Yeah. So I don't think we're in the danger. What you're going to see, the result of that is fewer homes for sale, which were already short supplied. So you're just going to adjust that pressure from that standpoint. So anybody looking for a home, limited inventory, and there's going to be a lot of people fighting for it. So you're going to kind of see that pressure where housing prices may not drop quite as fast as they did in 08, 09, because there's still some underlying demand of people saying there just isn't that much out there. So when something comes available, I got to be ready.
It feels, based on, what you guys are saying, what I've read, it feels like there's going to be some people that get into trouble.
Yep.
But it feels this time around like it's going to be a little bit more like taking a shot from a 22 rather than a howitzer.
Yes.
Yeah.
Oh, yeah. Yeah, it's going to be limited. Like you said, people who maybe overpaid for something that they should have had an inspection on, those type of things. And then they may just say, you know what, the cost to fix up just aren't worth it. And you'll see maybe some of that type of foreclosure or adjustments. But in general, if I bought a new house, maybe I overpaid for it, but I locked in a 2.8 mortgage, and then I looked at what I could buy now at 7, I'm probably still happy, even if I overpaid, to say, yeah, but what I would be paying monthly is still a better deal than what I could get right now. So I think you're still going to have kind of that in between where you're still saying, oh, you know what, I maybe got a little carried away and overpaid, but what I'm paying monthly, I can afford. And comparative to what I could change it for, it's still the best deal I have out there.
So you talked earlier about how, you still got your income. Your income's not at risk. You're in a fixed interest. So those payments,
they're the same. Yep.
It's not going to be like 0%. And then by month 8, it's like,
right.
It ratchets up.
Yep.
How do you factor inflation into that though? Because when people were buying these houses like crazy, inflation wasn't raging like it has been for the last 8 months.
Yep.
What is it? But right now, I mean, the new numbers came out just yesterday, 2 days ago.
8.3.
Yeah. And so it ticked up a little bit. So that means that prices are still increasing. Like core inflation is still increasing.
Yep.
And they're talking about how energy prices are going to go up somewhere between like 10 and 28% over the winter.
Yep.
Just because of the price of natural gas and whatnot and oil in general. How do you factor like inflation? What impact does that bear on your ability to make a home payment? Because before you could make it because the price was
everything
down
else
here.
Yep.
Food, energy, all that stuff was down here, and my home price was up, or my mortgage payment was up here. Those things are starting to like kind of creep up in equilibrium in terms of its overall stress on your budget.
And that's where you look at the wage increase. So what is the average wage increase we're seeing this year?
5% per year.
Yeah. And so if you're getting an average of 5%, inflation's 8%, you're losing that 3%. Does that 5% hang out for a little while? Do you get a catch back up? And because there's 10 million jobs available and only about 5 million people looking for work right now, there's this disconnect. There's also been an increase in people changing jobs, looking for higher payment.
Yeah.
And so there's still the ability to adjust your income upward because there's a lot of people hiring. So you're right that inflation is impacting, and anybody who was on a tight budget to begin with is just getting tighter and tighter. And that's where you can see some pressure. But at least at this point, for a lot of people, there's the opportunity to adjust your wages still because there's a lot of job opportunities.
Two components of that is that in the CPI calculation, when you're looking at the shelter component, which is what housing would fit into, 60% of the shelter component is calculated using what's called owner's equivalent rent. So that would say, Shaun, you own your house, but what would you rent it out for? That's kind of how that is essentially calculated. And that is what's being calculated as most of the shelter component of CPI.
But that's all just like opinion.
It is. That's just it.
Well, I have a
$1 million
mortgage, but I'm going to rent it out for $3.
So that's just it. It's a little bit interesting there, but it actually, the math
seems
of it.
Funny, Austin.
It is funny.
It seems really funny.
And it takes 9 to 12 months to see the craziness of housing price increases or decreases to really be flushed through to owner's equivalent rent in the calculation. So we actually still have more upward pressure from the housing price bubble boom. Maybe I shouldn't say bubble that we have experienced over the last year or so. I know people don't like bubble. People don't, but I mean, skipping inspections and buying for $50,000 over asking sight unseen, like that sounds bubblish to me. But anyway, that's a different question for a different answer. But owner's equivalent rent is part of that calculation. But the other side of that coin is the fact that the majority of Americans, if they're homeowners, bought a house prior to where we are right now in the housing market, prior to 7% mortgages again, prior to really jacked up home prices. So a lot of people, especially if they have a fixed rate mortgage, they're locked in at a 3 or 4% 30-year mortgage, depending on when they bought it over the last decade. And they have a house that they bought 50% less than it's worth right now. So they're in very good situation, and they're not actually being impacted by that shelter component of CPI. So their personal inflation rate might be less than 8.3% because their fixed rate mortgage on their house they bought 7 years ago is the same as it was 7 years ago. Yeah. So they might only have a 6% inflation rate. So we see a little bit of noise when we think about the inflation that's published on the news every month or whatever, because that's not people's actual personal inflation.
Yeah, because we're talking about like core inflation.
Yeah.
And how much that affects the overall rate of inflation versus like, well, when I go to the store, how much are the noodles that I buy? How much more expensive are those?
Very different.
But that rate of inflation on my noodles is going to be different than what I'm paying for natural gas.
Yes.
That rate of inflation is going to be different.
And that's why they strip out food and energy to get the core. Because
Yes.
food and energy, they have independent of the rest of the economy of their own cycles based on supply and demand on food prices and energy prices. Tune in next Thursday as we continue our conversation with Shaun.
Talk to you later.
Thanks. Bye.
Thank you for listening to the Invested Dads podcast. This episode has ended, but your journey towards a better financial future doesn't have to. Head over to theinvesteddads.com to access all the links and resources mentioned in today's show. If you enjoyed this episode and we had a positive impact on your life, leave us a review, click subscribe, and don't miss the next episode. Josh Robb and Austin Wilson work for Hicks & Zerker Capital Management. All opinions expressed by Josh, Austin, or any podcast guests are solely their own opinions and do not reflect the opinions of Hicks & Zerker Capital Management. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Hicks & Zerker Capital Management may maintain positions in the securities discussed in this podcast. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Past performance may not be indicative of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses which would reduce returns. Securities investing involves risk, including the potential for loss of principal. There is no assurance that any investment plan or strategy will be successful.